Imagine this. You watch your portfolio drop 30% in weeks, and you sell everything in panic, only to see it double the very next year. Or worse, you FOMO into the next big thing at the peak and watch your money evaporate overnight. Sound familiar? These aren't random bad luck moves. They're the direct result of two ancient emotions hijacking your brain: fear and greed. In the last decade alone, fear and greed have cost everyday investors trillions in destroyed wealth, while a tiny group of calm, disciplined people quietly became millionaires by doing the exact opposite of what the crowd did. Today, we're exposing exactly how fear and greed secretly control every market move, backed by real crashes, bubbles, and the psychology behind them. And most importantly, how you can finally beat them so your money works for you instead of against you. Stick around because mastering this one thing could be the difference between staying broke and building real lasting wealth. Let's dive in. Fear is the investor's silent killer. It doesn't arrive loudly. It creeps in quietly, disguised as caution, until suddenly it owns your decisions. It's that gut-wrenching panic when markets drop. Your screen turns red, your stomach tightens, and your brain starts whispering, "Get out, now, the world is ending." In behavioral finance, this is called loss aversion. Humans feel the pain of losses twice as strongly as the pleasure of gains. Think about that. A portfolio dropping 10% feels catastrophic, even though a 10% gain barely excites us. Fear hijacks logic. It forces impulsive choices, and it turns rational investors into emotional gamblers. Look at history. During the 2020 COVID crash, the S&P 500 collapsed by roughly 34% in just 1 month. Headlines screamed recession. Social media predicted depression. Millions of investors panic sold at the bottom, locking in permanent losses. But those who held on, or even bought more, they saw their portfolios rise over 100% within the following year. Same market, different mindset. Fear also creates herd behavior. When one person sells, others follow. Everyone rushes for the exits at the same time, amplifying downturns. That's how flash crashes happen. That's how bear markets deepen. People don't react to fundamentals. They react to each other. It becomes a feedback loop. Prices fall, fear rises, selling increases, prices fall even more, and the cycle repeats. Now here's the twist. Fear isn't entirely bad. It exists for a reason. It can protect you from reckless leverage, obvious scams, or blindly chasing hype. Fear can be a warning signal, but it was never meant to be your decision maker. The real danger is when fear replaces strategy, when it overrides data, when it ignores long-term plans, when it convinces you to sell low and buy high. That's how wealth is destroyed. Smart investors don't eliminate fear. They manage it. They use rules instead of emotions. They diversify. They invest automatically. They zoom out when markets crash because they understand one truth: markets reward patience and punish panic. Fear makes you survive today. Discipline makes you rich tomorrow. On the flip side, greed is the siren song of investing. It's that euphoric rush when everything's going up. Your portfolio is green, social media is buzzing, and a quiet voice whispers, "This time it's different. Get in now." Greed fuels bubbles. It pushes asset prices far beyond reality, beyond fundamentals. Remember the dot-com bubble in the late 90s? Tech stocks exploded on pure hype. Companies like Pets.com were valued in the billions, despite having no profits, no sustainable business model. Investors piled in anyway, chasing quick riches. Then reality hit. In 2000, the bubble burst. The Nasdaq crashed nearly 78%. wiping out trillions of dollars almost overnight. Greed today wears a new mask. FOMO, fear of missing out. It drags people into meme stocks, pump and dump schemes, and crypto frenzies during bull runs. In 2021, Bitcoin surged to nearly $69,000 as greed hit a fever pitch. Everyone wanted in. A year later, it crashed below $20,000. Late buyers paid the price. Greed blinds you to valuation. It makes you overconfident. It convinces smart people to take reckless bets, believing they'll exit before the crowd. Spoiler, most don't. But here's the twist. Greed isn't always evil. In small doses, it can fuel ambition. It can push you to take calculated risks, like investing early in quality growth companies. The difference? Discipline. Set rules, study fundamentals, and never confuse hype with value. Because in markets, unchecked greed doesn't make you rich, it makes you exit liquidity. Fear and greed don't just control individual investors, they move entire markets. CNN's Fear and Greed Index tracks this emotional cycle. Extreme fear often signals hidden buying opportunities. Extreme greed warns that a correction is coming, and it's not random. These emotions are hardwired into us. Fear once kept our ancestors alive. Greed helped them stockpile resources. But in investing, that same wiring creates dangerous cycles. Greed pushes prices far beyond reality. Fear slams them back down. Look at the 2008 financial crisis. Greed fueled reckless subprime lending. When reality hit, fear spread globally. Trillions vanished overnight. Yet while most panicked, legends like Warren Buffett bought aggressively and later earned massive returns. The lesson? Markets aren't rational. They're emotional. Master your emotions and you master money. Or as Buffett says, be fearful when others are greedy, and greedy when others are fearful. So, how do you actually beat fear and greed? First, build a solid plan. Not hype, not emotions. A real strategy. Set clear goals like long-term wealth or retirement and commit to them. Diversify your investments. Never put all your eggs in one basket. Then use dollar cost averaging. Invest fixed amounts regularly. When prices fall, you buy more. When they rise, you buy less. This simple habit fights fear at the bottom and controls greed at the top. Second, educate yourself. Read timeless books like The Intelligent Investor by Benjamin Graham. Knowledge replaces panic with confidence, and track your emotions. Keep a journal. Notice when fear tells you to sell, or greed pushes you to chase gains. Awareness creates discipline. Third, use tools. Set stop-loss orders to protect against big losses, but avoid overtrading. Every trade costs money. Let your plan work. Finally, think long-term. Markets rise over decades. During fear, remember recoveries always come. During greed, pause and check valuations. That's why pros stick to index funds. They remove emotion entirely. Follow these steps, and you stop investing with feelings. You start investing with systems, and that's how you win. Fear and greed are the yin and yang of investing, two powerful forces that drive every market cycle. Every crash is fueled by fear. Every bubble is built on greed. The goal isn't to eliminate these emotions. That's impossible. The real skill is learning to recognize them and stay disciplined. History shows us this again and again. When fear takes over, prices fall and opportunities appear. When greed dominates, assets become overpriced and risks get ignored. Yet most investors do the opposite, selling in panic and buying in excitement. The solution is simple, but not easy. Build a plan, set long-term goals, diversify your investments, and stay consistent. Keep learning. Use dollar cost averaging. And most importantly, stay calm when emotions run high. Because successful investors aren't the smartest people in the room, they're the most patient. Master this mindset, and you won't just protect your portfolio, you'll grow it over time. If this video helped, hit like, subscribe for more finance insights, and comment below, what's your biggest investing emotion? Fear or greed? Thanks for watching. Invest smart, and I'll see you in the next one.